With growing fiscal concerns, how should investors be positioned amidst a landscape of growing uncertainty? Fears of a global recession were tempered in May as the de-escalation in tariffs between the US and China came earlier than expected. However, policy uncertainty remains elevated on the tariff front as President Trump walked back his threats for higher tariffs on EU exports to allow time for further talks until July deadline. The latest legal challenge posed by the US Court of International Trade to rule against the Trump administration's tariffs adds further uncertainty, though this has been temporarily suspended by a federal appeals court. A big focus in May has also been on the sustainability of the US fiscal position. US fiscal deficits are poised to be at the highest levels outside of war or crises due to President Trump's tax-cutting plans. This has contributed to US sovereign debt being no longer rated AAA by any of the three major credit rating agencies after Moody's downgraded the US credit rating. Tepid demand during the US Treasury auction in mid-May also resulted in broad weakness for US assets as US bonds, equities, and the US dollar all weakened simultaneously. In our view, the increasing doubts over the safe haven status of US Treasuries underscores our thesis that the US dollar has peaked. Furthermore, deteriorating fiscal positions would likely result in 10-year US Treasury yields rising towards 5% over a 12-month period and keep upward pressure on inflation. We think the US Federal Reserve will likely keep interest rates higher for longer, above 4%, and make just one 25 basis point cut this year. Looking ahead, we expect market volatility to stay elevated on persistent tariff uncertainties and fiscal concerns as the 90-day deadline for trade negotiations draws near in July. Within equities, we maintain overweight positions in Europe and Asia ex-Japan and neutral positions in US and Japan. In fixed income, we remain neutral on duration. We are maintaining neutral positions in US Treasuries and developed markets investment-grade bonds and underweight positions in developed markets and emerging markets high-yield bonds. We favor gold as a hedge against inflation and US fiscal sustainability concerns. Amid this uncertainty, investors should maintain an adequately diversified portfolio across asset classes, currencies, regions, sectors, and investment styles. I'm Jean Chia, and this is Bank of Singapore Research.
For more information, please refer to this month's monthly investment guide.